Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
Welcome to our latest Fixed Interest podcast. I'm Deborah Murnin, and I head up U.S. Investor Outreach at Fitch Ratings. I'm joined by Rob Galtman and Jonathan Reid from our TMT team to discuss AI implications for service businesses. Rob, key report takeaways?
Thanks, Ed. The main takeaway is that AI disruption risk across services is real and evolving real time, but it's very uneven. We took a look at nearly 200 North American diversified services corporates and found that at the portfolio level, risk appears relatively contained over the next few years. We did, however, identify 4 issuers with what we define as high AI disruption risk, though that could change if adoption and capabilities evolve faster than our base case.
And one of the challenges here is that services is so varied.
Yeah, exactly. It's a very disparate sector. Fintechs, insurance brokers, data and analytics companies, many others. These businesses differ fundamentally in how they create value, and that shapes how they're exposed to the AI-driven change.
So if our listeners hear AI risk in services, what should they focus on first?
Well, most rated issuers benefit from at least one protective feature that limits near-term disruption. We highlighted in our report physical or field-based service delivery, proprietary data, regulatory entrenchment, high accuracy requirements, and the scale and financial flexibility to invest in AI as competitive advantage rather than absorb it as a threat.
So the question isn't just whether AI can perform part of a workflow, but whether the business model has structural protection.
That's right. Physical and field-based businesses depend on on-site labor, equipment, and local expertise. AI can't replicate the core service here. Meanwhile, companies with proprietary data or embedded positions in regulated processes may actually strengthen their competitive standing as AI increases. And larger, well-capitalized companies are better positioned to invest in proprietary AI solutions or acquire capabilities.
Let's get into where the pressure is most immediate.
Customer experience and business process outsourcing, or CX and BPO, is the clearest high-risk area, where AI can more credibly replicate the core value proposition. Chatbots and AI-driven triage tools are already being used by banks, insurers, and telecoms to cut costs. T-Mobile's a great example. They recently guided to around $3 billion in cost savings by year-end 27 from digital and AI customer service initiatives. So for CX and BPO operators, if clients need fewer agents, that goes right to demand.
And how does that translate into credit differentiation?
So the ability to pivot becomes key. Financial flexibility and balance sheet strength are critical survival variables. The 3 speculative grade issuers that we identified as high risk in this exercise are rated B or below, which typically means weaker capacity to invest in response or to absorb transition costs.
What about the subsectors that are in the middle ground?
Well, that would include areas like insurance brokers, consulting and accounting firms, data and analytics companies, which is roughly a third of our portfolio, which we've defined as medium risk. AI could meaningfully change workflows here, cost structures, and competitive dynamics, but the core value prop remains intact. Nonetheless, there are some real risks investors should consider.
Consulting and accounting are often cited as obvious disruption candidates. Does Fitch agree?
Only partially here. We think near-term risk is somewhat overstated, though it could increase over a 5-year or longer horizon. Consulting firms historically benefited from tech cycles because clients needed help implementing change, and we're seeing that here. In accounting and audit, regulatory mandates and independence requirements create meaningful barriers. Also, hallucinations and errors that are prone in AI today will need to be improved before we see mass adoption for customer-facing financial areas.
And what about insurance brokerage?
History matters there too. I think insurtech has threatened carriers and brokers for years without any meaningful disruption. AI may be as likely to be a competitive tool for the incumbent brokers as a threat.
And what about the lower risk end?
So fintech and physical or field services have low near-term risk. In fintech, core services like payment processing are already technology-driven and often benefit from network effects. And field services like pest control, home repair, facilities management, these still rely on on-site execution. Over the longer term, robotics could matter more, but that's not our near-term base case.
You also frame this as a dynamic risk, not a static one. Can you explain?
Yeah, that's key. So AI is evolving quickly, requiring continuous reassessment. The ultimate credit impact depends on whether AI erodes incumbent moats or disproportionately benefits well-capitalized players with proprietary data and scale. It's sector and issuer specific, and it could take years to fully materialize.
Okay, so the takeaway is really a differentiation story.
Exactly. At the portfolio level, risks look manageable for now, but there are clear pockets of near-term pressure. especially in CX and BPO. Elsewhere, the key question is which issuers have the structural protections and, importantly, the execution capacity to adapt as AI adoption evolves.
Rob and Jonathan, thanks so much for the discussion, and thanks to our audience for listening.
Thanks, Deb.
Thanks, Deb.
Subscribe to Fixed Interests wherever you get your podcasts.